Hi, I'm James Robinson, and this is a Robinson Stocks stock pick. This is the second in my 5-part series on the company OFLX, symbol OFLX. On this video, we're going to be talking about the company's operations. I look at operations as how efficiently does the company deliver goods and services to the customer. The more efficiently they're able to do that, and the more that company is able to demonstrate that it has some type of durable competitive advantage or some type of consumer monopoly, the more I'm likely to be interested in the company. The first thing we look at when looking at a company is the company's gross margins. I know that might seem like a strange place to start. Most people would start by looking at the company's stock price or maybe the company's earnings. But for me, gross margins is where you should start looking at, and I'll explain a little bit about why. Warren Buffett teaches us that we need to look for companies with a durable competitive advantage. We need to look for consumer monopolies. And the reason we're looking for a consumer monopoly is because it has pricing power. When inflation comes, you want a company that can raise prices along with inflation. You want a company where when something goes wrong, they've got a buffer zone, a margin of safety that will allow them to continue to be profitable even in rougher times. So gross margins to me is the way that we measure that. Gross margins is simply you take the total amount of revenue, you subtract out the cost of goods sold, and what's left is your operating income, and the difference between operating income and revenues is your gross margins. So what I'm looking for is durability. So I'm looking for those margins to be relatively consistent over a long period of time, and I'm looking for them to be, higher than the average company. So when you look at this chart in gross margins, you can see that really since about 2011, the company's gross margins have actually been increasing. That tells you that they have real competitive pricing power. One of the things that would happen if there were new competitors coming into this market space, then they would be competing on price and they would be dropping the margins. So when the company's able to keep the margins flat and consistent for this long, that means that there's no real competitors. And that again leads us to this idea of a consumer monopoly. So a lot of things you can tell by just looking at these charts. So again, the light blue line is the top 25% of companies. And so that tells you that this company is way above average in terms of the gross margins. And because it's so basically flat, that tells you that they have a durable competitive advantage. And when I see a company like this, that's a real green light that I want to continue to look at this company's operations. So this slide is looking at the company's earnings and their earnings per share. And you can see that from 2011 through basically 2022, the company has had significant increase in earnings going from, let's call it $6 to $25 over that period of time. That's a fantastic improvement. So normally I would give that company, a 4 on a scale of 1 to 4. However, for the last 2 years, those earnings have come down. They haven't come down a ton, but they've come down significantly. And so that would give you a pause, right? But I've done a lot of work in the construction business in terms of looking at companies in that business. And I just believe that the construction business is in a lull. Inflation has really hurt construction costs, really hurt the amount of construction going on. The economy has been soft, and as a result, this company's earnings are down. But they're not down to the point where I no longer think it's a good company. The margins have stayed where they are. There's just less construction. Well, America's going to, over time, do a significant amount of construction. I think over time, the amount of construction is going to improve. And so I look at this as a real buying opportunity because I believe that the economy is turning around, and I believe that this company is going to start to go back to historic levels of sales, and we're buying the company at these low levels of sales when people are more pessimistic. So I think that's the only reason we're able to get this company at the PE ratio we currently are. So that's why I'm not really worried about a 2-year downturn in the company's earnings. This slide will help you understand also why I'm not that worried about the short-term earnings. And again, for me, I'm not like most investors where I'm looking at day to day. I mean, for me, a 1 or 2 year blip is not the end of the world. I realize most investors are worried about what happened in the last 15 minutes. I just take a much longer approach to it than most people do. But if you look at, again, from 2011 until, the last year, the earnings, let me start over. We're looking at 2 slides. Net earnings is a percentage of revenue. So for every dollar of sales, how many dollars reaches the bottom line? And then we're also looking at earnings and revenues. And you can see here that from 2011 through today, the net earnings that have hit the bottom line have been increasing. They've been very consistent. And even though the last couple of years, there's been a reduction in sales that hasn't resulted in a significant reduction in the amount of revenue as a percentage hitting the bottom line. So that tells me this is a very healthy business. They're managing the business intelligently. Yes, there's ups and downs in the economy, and like every company, they're going to suffer a little bit when that happens. But the business itself is very, very well run. It's very efficiently run. The efficiency with which it's run is getting better over time. And so again, I'm willing to overlook a couple of years of bad earnings, and that's the only scenario in which a company like this is going to become affordable for an investor like me. The other slide here is we look at his revenues. You can see revenues since 2008 have gone up dramatically from, let's call it, $45 a share, $45 million of revenue to 110 at its peak, down the last couple of years, but still above where it was in 2019 or 2020. So again, I'm fine with that. So now we're going to look at what I call the four taxes. So there are costs to run a business which are not related to the cost of goods sold. Those four costs are, broadly speaking, selling and general administrative costs. I look at those as a percentage of gross profit, plant and equipment as a percentage of assets. I look at inventory as a percentage of revenues, and I look at R&D as a percentage of gross profit. So what I'm looking for here is consistency, that the company continues to remain healthy, that the company is not wasting a tremendous amount of money or ineffectively using our money. For example, if a company has a ton of money in inventory, I have to worry about what's going on with that inventory. So the first thing that I look for in these charts is that the charts are relatively flat, and they are. The second thing that I look at is that they're sort of at least average or above average. And you can see that the green line represents, on the selling general administrative, the chart on your left, that number, the green line represents the top 25% of companies, the light blue line represents the bottom 25% of companies. And you can see we're smack dab in the middle of that. And you can see within a few percentage points, this number has been flat for 15 years. So what that's telling me is, yeah, there's selling and general administrative costs are average, they're nothing special, which by the way is not surprising for a manufacturing company, but that they're very consistent. And even though they're up the last couple of years as a percentage of profit, that's because the profits have been down. Long story short, this is a very stable company that I can bank on and predict what's going to happen in the future. And that's what I'm looking for. The same thing can be true for plants and equipment. That number has been basically flat since 2004. It's on the better end, right? So if you look at the green line, that is the top 25% of companies, and the purple line is the bottom 25% of companies. So they are above average. They're not great. But again, because it's so consistent, I'm perfectly fine with it. Inventory as a percentage of revenues is something that is bothersome. The reason that I don't like it is because what people don't think about with inventory is there's two different factors. There's two different factors with inventory. The first one is that the money that's being used to buy that inventory is not available to us, the shareholder. And so it's money that basically is tied up in the operating the business. I like that to be as low a number as possible so the company doesn't require a lot of assets so they can pay us more money as shareholders. The second issue is that the money that is tied up in assets is sometimes eroding in value. So if using the best example, if your company makes apples and you have a ton of inventory in apples, if you don't sell those apples within a certain period of time, they're just garbage, right? They go bad, they get rotten. And so you have to get rid of them. So when I'm looking at this company, we make corrugated steel cable. That doesn't go bad. Simply we slow down production and the sales will gobble up our inventory over time. And so I don't really have a big problem with that. I do not like the fact that we're in the bottom 25% of companies for inventories, except that you have to put that in some context. So a software company has no inventory. So even though they sell a bunch of stuff, we're competing with them as one of the 100% of the companies that we're looking at. Some percentage of those are software companies. Some percentage of those are service businesses, again, which have no inventory. So these numbers are skewed. So we are in the bottom 25% of companies. It's not a very big number. 15% of revenues are being tied up in inventory. The inventory doesn't go bad, and manufacturing companies are really the only companies, and retail companies are really the only companies that have a ton of inventory. By the way, some of the inventory can be raw materials to make our products. But again, and if you look at this even differently, you'll realize that the last 2 years, the inventories have been flat. So that's kind of a long way of getting into saying I'm not really worried about the inventories, but it does give you a sense of what I'm thinking about when I look at a company's inventories. The other thing is R&D. I like companies to spend a little money on R&D. A lot of companies spend nothing on R&D, and a lot of companies spend a ton of money on R&D. I don't like companies that spend a ton of money on R&D because R&D is research and development. The problem with R&D is that there's no guarantee it's going to lead to anything. You could spend $1 billion on R&D and come up with a product that nobody likes and doesn't generate any money, and you may as well have burned that money. But generally speaking, I think your company should always be looking to improve its products to try and keep its competitive advantage. This company, in terms of their gross profit, is spending 6 or 7% on R&D. They've done that for a very short period of time, and they've managed to keep their competitive advantage over that period of time as measured by gross margins. So I think you can be totally comfortable that this company's R&D budget is very sensible and is generating reasonably good results. A fifth tax that a company can incur, which is by the way voluntary. The other 4 taxes are a byproduct of running your business. You simply have to spend some amount of money, generally speaking, on some combination of those 4 taxes. But the fifth one, which often is the biggest one and is often the most problematic, is interest expense. This company has no debt, so it doesn't really have any interest expense. And so there's not much to talk about here. But oftentimes, this is a disqualifying thing. Many companies are piling on debt as a way to stay operational, and that's a really big red flag. You won't very often see that in the companies I'm recommending, but it is something to be concerned about. So here is the summary of operations. Generally, I look for companies with a gross margin of at least 40%. This company's gross margins are north of 60%, so they're spectacular. They've been this high for over 10 years. To me, that means the company has a moat. It means the company has a durable competitive advantage. And it means at the right price, it's going to be a company I'm typically very interested in. Our earnings have been down for the last 2 years. I believe this is due to economy rather than the business. There's a 500% earning increase over the last 20 years in a very low tech industry with good margins. I think that is a sign for which I'm willing to override any concerns about the last couple years' earnings. Selling and general administrative have been higher than I would like, but they've been consistent, and it's a nuance of this business I can live with. Inventory is also, higher than the general business, but it's not bad for a manufacturing company. And again, the inventory that they have, generally speaking, it's never gonna get rotten or go bad or become obsolete. So it's not the end of the world. R&D is low and shrinking as a percentage of gross revenues. Interest is a non-factor for the company. Plants and equipment costs are manageable and consistent for 20 years. So long story short, the operations of this company are very good, especially very good for a manufacturing business, which has trouble competing in some of these categories with other industries. So this is a really big green flag for this business. So I'm James Robinson. Thank you for your time.